see these recordings, and you can also catch up with all the sessions that we've been doing for the past 2 weeks on our YouTube channels. So the first thing that I want to talk about today, we want to address the trends that I talked about in the previous session that we had. In the previous session, I was talking about market sentiment. Then we said there is a way of relating market sentiment to what the market is likely to do. So we want to look at, it was Euro JPY, which I gave an example of. And I still remember, if you can all see from my screen, I said Euro JPY is going to buy, but the reason why it wasn't buying is because the market sentiment had a lot of buyers at the time, more than sellers. So they took time to actually shift away from this zone. From this zone, they kept on coming back to the peak because they had not trapped enough contracts for them to go up, and also there were a lot of buyers. So for them to go up, it would pay a lot of retail traders. So if I check the market sentiment for today, let me check. If I check the market sentiment for today, let me just open my browser. That can also show you the market sentiment for today, when they actually moved it today. So as you can see today, as compared to last time, that was a day ago, we are focusing on Euro JPY. And if you check even from the previous sessions that we did, you see the market sentiment had a lot of buyers at the time. There were about 74% of traders that were buying, and there was about 30-something% of traders that were actually selling. But can you see how the market sentiment changed? Which means when the market was refusing to go up, it was inducing more people to sell. And as more people were now selling, the market sentiment changed. Traders actually thinking that it's now a sell because it was refusing to go up. And as they induced more sales, up to 64%, they then reversed the price. And all those that had entered sell positions, they actually got trapped along the way when the market moved up today. So you can see that this plays a very important tool in making your market decisions, because traders were induced to go short, and all those that went short, they actually got hit today because the market just moved up today with a very big aggression. Can you see this is a 1 hour candle, which means in 1 hour, the damage was already done. Everyone was induced to sell. Everyone was induced to sell. Got hit by only one shift candle, hitting all the stop losses that will be somewhere around here. So the move to the upside was just to crush everyone. We had entered a what? A sell. So your market sentiment is very, very important. So today, I also want to talk about our retail trader patterns that retail traders use in making their decisions, which actually makes them difficult to even realize. I can see some people are saying there's no sound, there's no sound, there's no sound, there's no sound, there's no sound. Can you all hear me? If you can hear me, please raise your hand, wave your hand. Okay, so those that are having audio issues, I think it's the devices that you are using. Just make sure that you reconnect and make sure you are using internet audio. So the problem is not here because some are actually hearing me loud and clear. So you need to fix your audios. Okay, so moving on, I want to talk about retail trader patterns. retail trader patterns, retail patterns. One thing that I want to teach you today is when the market presents itself, you should wait for it to present what you already know at the right time. The problem usually arises whereby what you know already as a trading strategy, whether you're a price action person, whether you're an ICT person or a BTM person, the problem arises when you want to apply what you know at the inappropriate time. Timing is one of the most important things to really pay attention to when it comes to trading. And the market pays those that are patient enough. And you actually need to be patient with the market so that it comes to where you want it to come, then you execute your trades. So what happens is you want to apply the strategy at the wrong time. And when you apply the strategy at the wrong time, that's when your trades, they fail to validate. So what I want to talk about today is what we call retail trader patterns. We've got a lot of retail trader patterns. Retail trader patterns, we can talk about head and shoulders patterns. Head and shoulders patterns, we use them in BTMM, but they should appear at the appropriate time. They should appear at the appropriate time. So when a retail trader person sees a head and shoulders, we are now induced to actually sell because a head and shoulders is actually a strong reversal pattern that most of us use, all of us use. But if that pattern validates or presents at the wrong time or at the wrong market position, it's actually a trap. Why I'm saying this, I can take a relation of Euro US dollar. Euro US dollar today, not almost for the past 2-3 days, they were validating a head and shoulders pattern. Let me look at Euro US dollar. Let me zoom it a bit so that you can actually see what I'm talking about. Euro US dollar was validating a head and shoulders pattern, which was here. This was a head and shoulders pattern, which was being validated by Euro US dollar. And I know quite a number of people that were actually induced to sell or to go short, saying that we've got a strong reversal pattern, and actually the market was showing signs of a very strong resistance, which was right above there. Even if I am to zoom out this chart, you'll notice that here, let me go on my 1 hour time frame. You notice that on this point where the market was today, let me draw this line that is there. There was a validation of a very strong resistance which was being validated there on a 1 hour time frame. The last time the market was validating a resistance, was still validating a resistance, the market was still coming and testing this area, keeping on and coming and testing this area, and this was a validated resistance. When the market came again in this week, it was still validating the same resistance, which means there was an area of interest, which means just by knowing support and resistance, it actually puts you at a very much bigger disadvantage to the market, because the market makers, they need to validate these things because they know we read about support and resistance almost every time, and almost every book, like I always say, it always teaches us the same things. So they're actually validating some resistance here, inducing traders to actually go short. Some trap also happened last week. I think I showed you in the previous session, whereby there was also some validation here of some support here, inducing traders to buy. And when they go down, they hit everyone who had entered a buy, because we're in level 2 and we're actually wanting to go to level 3. So the same thing happened. They came back, they pushed, then they got to an area whereby they kept on validating a very strong resistance there. And you know what? When the market comes for over 3 times, that's a very valid resistance. Come here, rejects. They just wait for a lot of retail traders to actually enter more positions, sell positions in this case. And they just wait for news. They use news as an excuse to break the level. Everyone who went short, validating that resistance for almost the whole week. Imagine how many traders there. With one candle, they've done all the damage, hitting all the stop loss of everyone who went short, pocketing your money. Then they are done. But we knew that they were actually in level 1. They still had to go up, because this was our peak formation. This was our V1 area, and we had to look for a V2 somewhere there. Then we validate our market maker cycle. So it's always good to know the market maker cycle. It's always good to know the market maker cycle, because it puts you at an advantage to avoid traps, because you know where the market makers are actually trapping. I don't know who's writing on my chat. Please stop doing that. If you don't want to be part of this session, please just exit. Don't disturb everyone. Okay, so moving on, I've talked about the head and shoulders pattern. Now, I want to talk about what I call which are the retail trader pattern that we use. We talked about support and resistance. We talked about the head and shoulders formation. In this case, where it was used to trap, in this case. So I want to tell you, let me open something for you that can actually help you. I hope you'll be able to take notes from them. Like here, I told you they were validating head and shoulders pattern, which then failed to validate, which means it appeared at the wrong time. You should only take a head and shoulders pattern when it appears in peak formations. So there are certain patterns which are supposed to appear in peak formations, which you know when they appear in peak formations, they actually reveal a reversal setup. And if they appear anywhere else in the wrong market segment, they are meaningless and they are used as trap patterns. So let me look for some notes with some retail trader patterns. Let me open this one. I hope you're all able to see. Let me open this one. Okay. So one thing that I want you to appreciate is we want to talk about a few retail trader patterns here. These are most of the retail trader patterns that are used by a lot of people that use price action mostly and as patterns. But like I said, patterns, they do work, but if they appear in the wrong market segment, they are used as traps. And you should know when the market is actually trapping you. So they know, a lot of people, they don't know when the market is about to reverse or when is the wrong, inappropriate segment where the market gives you a pattern. And when you fall for it, they will punish you for that. So here we've got double bottoms, inverted head and shoulders, bullish channel, the flag, and quite a number of retail patterns that we have here. But if they appear at the wrong market segment, they mean traps. They know that you know these things because you read about this in the books. You see about this in a lot of YouTube videos, and they know you're going to use this. So if they appear in the wrong market segment, they're going to be used as traps. So usually when they make you see a double bottom, the actual move that they usually take is they induce you to buy in this case, but they actually reverse to come down. Even here, they also reverse. This is what they do because they appear as continuation patterns. Most of these retail trader patterns, they appear as continuation patterns, like some flags, some triangles, some rising wedge, and all of that. And they use this usually as continuation patterns. And they most of the time, they appear in peak formations. Why they appear in peak formations is because in peak formation, that's where they're about to reverse. So when they reach the peak, or what we call level 3, they make sure they validate any of those patterns that you see in front of you. And they know you're going to fall for those patterns as continuation patterns. And after you enter that continuation pattern, let's say they have been buying and they are now in level 3, they show you a continuation pattern so that you are induced to keep on buying. But while just in level 3, that's where they're actually looking to reverse. So at the end of the day, they look more like, let me show you how they're going to look like at the end of the day. They're going to hear what you call a wedge or a pennant. You know, when a wedge or a pennant is validated, if you see a wedge, a pennant, or some wedges like this, a rising or falling wedge, it's a continuation pattern. So what they do, they validate a pattern like this, a pennant or a wedge at level 3, so that when they break the pennant to the upside, we are saying that the resistance is broken and this pattern induces more traders to buy. But in actual fact, they are trapping you to buy, then they reverse the market. At the end of the day, they'll be making an M formation like this. And also when they give you a wedge, they know when that wedge is broken, you see a wedge is broken, there's a retest, traders are induced to buy. They just come down. So at the end of the day, we know they are only making an M formation for a reversal at level 3. This is actually a trap. The same happens there. The same thing happens there. So these patterns, they usually validate, or they usually validate them at level 3. Let me show you examples of what I'm telling you about. You should pay attention to these patterns. If they appear at an inappropriate time, they're actually trapping you. So let me use a few examples that I have. Just a minute. Okay, yeah, I found it. So here's an example. We've got USDs here. We've got a pennant. Can you see the market creates a pennant, the one that I just showed you? It breaks to the high. It induces more traders to buy. Then they actually reverse because they will be in level 3. Then they make an M formation, then they go down. Let me show you another example. Here I've got Euro Australian dollar. Here's what they do. They've got a wedge pattern, a pennant pattern here. They break to the low, inducing more traders to go short because you are saying that these have broken to the lower side and it induces more traders to sell. We've got a break, we've got a retest. More traders are induced to sell, but they are actually making a W formation for the reversal. So this appears in level 3 or at the peak. Then traders are induced to short, they go up, leaving everyone who have entered the sell crying. The same things, this is a pound Australian dollar, level 3 behavior. They validate that, induces traders to buy. then they reverse, giving you an M formation there. So these are some of the things that you should be paying attention to. It's the same things which appear in the market almost every time in different pairs. This is GU, this is GU, this is Euro USD. They break to the low, induce short positions. They're actually making a W formation, then they reverse. So these patterns, they mostly appear in level 3. But when a lot of traders see them, they take them as continuation patterns, but you don't know that you're actually being trapped by the market. So it's actually very, very important that you avoid being trapped by paying attention to all these things. That's why I said it's important to also know the market maker cycle, to know when a retail trader pattern appears. Is it a trap or is it actually a real continuation pattern? So they do this almost every time. Then they trap traders and all of that. So these are some of the things that you should pay attention to. Don't fall for any of these market maker tricks because they actually use them to trap and take away your money. So retail trader strategy is not enough. Knowing about support and resistance only is not enough. Knowing about patterns like these wedges, pennants, and whatever is not enough. As a trader, you should give yourself time to study more into the market and have an understanding why they do what they do. So imagine how many traders are there in the world and how many are profitable. You see that the majority loses to the market. Even if you read all the books that you ever come across with, you can watch all the YouTube videos or whatever that you might want. But as long as you don't have an understanding of why the market makers do what they do or why they are doing this, then you always be in trouble. So knowing a strategy and understanding a strategy are two different things. You can know how to draw trend lines, you can know how to mark levels, you can know how to do whatever. But as long as you don't have an understanding of what you're studying, then you are not going anywhere. You need to develop a very deep understanding of whatever strategy that you are studying. And you need to work on developing that strategy as much as you can. Okay, so moving on. I want to talk about what we call the trend lines, like the trend. You know, when traders trend, like retail traders trade, we are told in the books that we all read, or most of us read, we are told to trade in line with the trend, but they don't tell you where the trend is going to end. So what usually happens is when we draw trend lines, you know, let's say in a trending up market, we can have trend lines like this, and we know everyone is told to trade with the trend, whereby if the market goes up, comes down, these are the areas of interest. You're told to trade with the trend. You're told to trade with the trend. These are your entry positions. And what have you know these things, you have read about it, and some of you use them, whereby you draw your trend lines and in an uptrend, and you're supposed to trade in line with the trend. Yes, you're supposed to trade in line with the trend, but you should know where a trend is going to end, because a trend ends at level 3. But if you don't know your level count, you're going to be in trouble when this happens, because the market makers, they need to validate this, which means they validate this and induce more traders to keep on buying in line with the trend. Then when you keep on buying, they then reverse the market on you. So this so-called trend is created with what we call daily structure. I've shown you a daily structure, which I showed you the other day. A daily structure, I said, is something which looks like this. Whereby we have an Asian session, we have got an HOD, we have got an LOD, we end the day back into consolidation for the next day. So this is what creates a trend. And this is what we use as part of our market maker method as a way to know where the market is supposed to go. So let me show you an example of what I want to highlight right here. So this pattern right here is the pattern that you see when you draw your trend lines. So what the market makers do is that trend line, those trend, that uptrend is created with respective daily cycles. So what happens is coming out of the Asian session, they do a stop and high in this case, they come down, they end the day back into consolidation. This one day. On the another day, they can start by doing a stop and low. They go up, they go down, they end the day back into consolidation. On another day, they can do this, go up, end the day back into consolidation. So in a way, we are actually creating a market maker cycle from this. We'll be actually creating a market maker cycle. We'll be actually creating a market maker cycle out of this, because we know that we have that the market goes up, ends the day back into consolidation, does the same thing. We'll be creating a market maker cycle. And in terms of our level count, we'll be actually in level 3. This will be our 3-day cycle. This will be our 3-day cycle, where we're saying after 3 days of rise, we expect a reversal. So if you don't know this, based on the market maker cycle, you don't know where the trend is going to end, and they're going to reverse on you. I can show you an example of what I'm trying to say. These respective daily structures is what creates these trends. So I can use an example. Let me go on my 1 hour time frame. Let me see what I can write, what I can draw. I can draw this one. You can see we have a downtrend right there. But if I look inside that downtrend, you actually see we've got respective daily structures. So if I switch back to my M15 and I try to zoom out, you can see it's the same pattern that I was actually drawing for you, whereby the market comes down, goes back up, ends the day into consolidation, that small blue box, end the day in consolidation, they go up, down, end the day in consolidation. We have another consolidation, end the day into consolidation, end the day in consolidation, end the day back into consolidation. So you see, we've got respective daily structures that create that trend, because they know retail traders, they trade with the trend and they draw their trend lines. They wait for price to react on that trend line. So they need to make sure that they are validated, they are validated, they are validated, they are validated, they are validated. So what do? They make sure that you keep on selling as the market goes down. But from there to there, this was level 1, level 2, level 3. Which means when the market gets here, you are kept on inducing to keep on selling. Because the market, when it gets that trend to that trend line, upper trend line, it sells, upper trend line, it sells, upper trend line, it sells. Which means at this point, that's where you're going to get trapped. They validate some rejection at that point. The moment you enter the sell positions there, they break going into level 2. And based on the market maker cycle, we knew we're in level 3 here. And this was actually a level 1 push. And this was actually a level 2. And they had to break to level 3. So you see the importance of level count. Let me attend to these questions for now. Can you help out with V100? It's a golden cross on M15. I'm not talking about that today. I hope you can all hear me. Then another question, go back on your previous chart. We saw that you had drawn support and resistance. No, on the previous charts that I had, I didn't draw support and resistance. Do you mean these charts? Which ones? No. Let me look for. If you are referring to these charts that are right here, if you're referring to these charts that are here, these are not, some you can call them support and resistance, but I call them zones. They are reversal zones. These are the zones that I draw on my charts where the market usually reverses. So like I said, when you are a patient trader, you should wait for price to get to a certain point where you want the market to come, then you trade there. On the bigger time frame, the retail trader patterns seems to be very validated. Yes, they are very, very validated. So as I was saying, these, I call them zones. They are not like support and resistance. This is something that I discovered, which tells me where the market usually tends, like 90 to 95% of the time. So if I'm to show you, it will probably cost us like the next three lessons for me to show you, but maybe I can just do a rundown. Maybe let me just show you a bit about it, whereby I know where price is going to come. Let me look for my chart so that I can actually show you what this means. Okay, I hope you can all see my chart. So what I do with my zones, I've got a customized Fibonacci retracement tool, which let me look for my clean template so I can actually show you. So what I do with this one is I've got a specialized Fibonacci retracement tool with certain set values that we came up with that tells us where the market usually tends almost 95% of the time. So I can give you an example of just, I hope I'll be able to finish, but let me go on my weekly time frame. Then I start to draw those zones. I hope I'll finish in time. So on my specialized Fibonacci tool, I've got quite a number of things that are there. I've got what I call major zones. I have pivot zones. I've got pullback zones. I've got minor zones. So all of these zones, they actually mean different things. Like I said, if I'm to talk about everything, I will need maybe the next 3 sessions to actually talk about it, but I'm just going to show you how I use it. I wait for price to come where I want it to come. Then I know that's where my M and W or my peak formation is likely to be formed. So let me just try to do this as quick as possible. I hope this won't waste much of our time. I hope it doesn't waste much of our time. So on these zones, I draw almost my horizontal lines on all the points that I have there, my pivots, my minor, my major points. I'm not trying to be accurate here, so let me just be quick so that So now I want to pay attention to where the current price is. I'm not going to draw everything. I want to pay attention to where the current price is. Then I can draw my zones around that area. Then from there, I go to my H4. I want to look for where the price is. So you can see almost 90% of the time, where I've drawn my zones is where the market usually turns. And this is where I know where my M's and W's are usually formed. So I draw my 50% minor points. I hope I'll be able to finish because this takes much time. I draw my minor. I want to only concentrate to the current price so that you actually see what I'm talking about. There. Then I go to my H4. Already you can see where the price usually turns. Price just comes to those zones and act on those zones. That's where the M's and W's are formed on those zones. Let me focus on the current price alone so that I won't have to waste much time. Come there. Let me remove this. Then let me go to my H1. So I want you to notice one thing. I can even switch even to the smaller time frame. So one thing that I want you to appreciate is where my zones are is where the market turns. So I wait for price to react on my zones. I can even go to the smaller time frame. Even here, I can even go to the smaller time frames to actually show you that that's where the market reacts, where I draw my zones. Like here, I can come and draw my 50% minor retracement there. And you can see that's where the market usually turns or reacts there. So I wait for price to come to the right place where I draw my zones. Like I told you, we come up with the customized Fibonacci 2 with certain values that we use to know where the market price turns almost 90 to 95% of the time. So I know my price is to get to that point. Then I know a reversal doesn't happen until price gets to that zone. So I wait for price to get to my zone. Then I wait for my M and W to form. You can see on the zones, that's where the M's and the W's of the peak formations are usually formed. That's where you see the M's and the W's, the peak formations, the reaction of the market. It happens on those zones. So I wait for price to come where I want to enter. I know someone was asking me, how do you make such good entries and all of that? I just wait for price to come and react at my zone, and I then take my entry. I hope I've answered that one who was asking me. Let me attend to a few messages. When do you take profit and pull stop loss after entering? After entering, my stop loss is always safe between 15 to 25 pips away from the high of the day or at the low of the day. So what I'm saying here is if I go on my chart, let's take for an example for today. This trade, we took this trade coming out of the Asian box. We had a very good stop hunt, and it came to the ADR low. So which means my entry was somewhere around there because I took my entry on 5-minute time frame. So it was actually quicker. But a much safer entry would be a close of the bullish candle above the 13 EMA there. That would be a good entry. Then your stop loss will be anything between 15 to 25 pips away from the low of the day in this case. Or you can put a stop loss just before the here where there are trap candles. That's how you can set your stop loss. I hope I've answered that one. I'm left with about 3 minutes because I had set about 45 minutes for our session. So I'm afraid it can anytime disconnect. What other question do I have? Can you please have the fib levels? You can come to my inbox, then we'll see what I can do for you. Do you have any question here? When should we trade continuation patterns in level 2 or level 3? You can trade continuation patterns in level 1 and level 2, yes. After they've set the peak. How can you validate a level? How can you validate a level? Okay, a level, if I think your question is direct to what I think what you're asking me is, how do you validate a level? A level consists of two things, a rise or a drop plus this consolidation. So which means a level should have both a rise and this consolidation or a drop plus this consolidation. That's what marks a level. I hope I have answered you because I'm failing to really understand where your question is. Can you count levels on VX? Yes, I can count levels on VX. Let me go on, let me open my binary so I can show you that even you can use even levels in volatility indices. Every strategy, guys, there is no such thing as binary trading strategy or what. The strategy that you use, it should work everywhere. It should work everywhere. So here, let me just show you. We do have level count in volatility indices. Let me show you there. And we're actually in a buy. We're actually in a buy on V75. I know I sent the setup to my students sometime 3 days ago, and it's been buying ever since. Dropped it as background. So we've got our peak formation. We've got our peak formation. How can okay, I need to fill that box. We've got our peak formation. We have got our first low. We've got our second low. And we've got our peak formation there. So already I've got my 3 levels there. I've got my 3 levels, as you can see. I've got my peak, my M formation, my drop, my consolidation, my drop, my consolidation, my drop. I've got all my 3 levels on, and they reversed. They create another peak. So you can also draw levels on volatility indices. And you can also have a confirmation of this. EMA crosses, they also confirm. And we see EMA is fanning out, indicating a level 3 behavior. I hope that is answered. What's the best way to identify a peak? Inbox me, I will send you a PDF that I've created for peak formations. Any lessons for beginners? If you want to have the beginners class, you can visit our YouTube channels, the Forex Plug YouTube channel. I managed to upload some free basic introduction to Forex trading. Then you can also find some introduction to BTMM and some of the lectures that we have been doing for the past 2 weeks. So you can also learn from there. Can you just send FIB settings in the Telegram group? You have to inbox me. Then I said I'll think about that one. If it's your lucky day, I'll give you everything that you need. Do you have any other question? Okay, you can inbox me. My contact is, you can find my contact. You can please go on our website, www.forexplugs.com. You can find my email and my phone number there, which I use for business. Okay, I think that is all for today, guys. For those who want to have a repetition of this, you can find the video on YouTube, any of our YouTube channels. We're going to be uploading it soon after this session. We meet again, hopefully tomorrow, and I think I will have something to teach you. And while it's to wait for Bongeni to come back, which is sometime on the weekend, then we can carry on with our sessions for the 14 days that we said we went to. Then maybe if the lockdown extends, we can then decide if we are to continue with these sessions. I hope they are helpful to you guys, and thank you for joining. Have a pleasant evening. Good night.